I guess nobody has not heard about the 2008 crisis, but were real lessons learned from this crisis, or are the same mistakes still being made? How is the financial world shaped today, and are we still feeling the effects of this massive wave? Let's start with the collapse of Lehman Brothers and examine step by step how the 2008 crisis affected modern banking and the economy. Everything started in 1844 in a small store in Alabama. A young immigrant, Henry Lehman, opened a simple trading shop. Soon his brothers Emmanuel and Mayer joined him. The story that began with cotton trading quickly grew unnoticed. And that small shop, years later, it would grow into the giant Lehman Brothers in the heart of Wall Street, determining the fate of global finance. What allowed Lehman to grow so much? Was the Gramm-Leach-Bliley Act passed in 1999. This law had torn down a barrier that had protected banks since 1933. The separation of commercial banking and investment banking. Once this wall was removed, banks could now both lend and invest and even operate like insurance companies. Money, risk, and power were no longer distinguishable from one another. And this new system transformed Lehman into one of America's largest banks. But the ironic and tragicomic part was, this very system, in a way no one noticed yet, was the first unseen step toward its collapse. While Lehman was rapidly rising on the American side, housing prices were also rapidly increasing. And this surge reinforced a fundamental belief that supported confidence in the entire financial system. The housing market would never collapse, but things were far from that. By late 2006, housing prices in America started to stall. Then came a small-looking drop. No one realized this was the beginning of a quake that could shake even giants like Lehman. Lehman held hundreds of billions in mortgage-backed securities. As the value of these assets fell, even on paper, they could not hold up. Confidence in the market was fading. Banks involved in transactions with Lehman began asking questions. Are these numbers on the balance sheet accurate? Are these assets really worth it? What happens to us if Lehman's debt doors close? Because Lehman was not operating only with its own money, funds, companies, and investors from all over the world were positioned through Lehman. And everyone started to feel the same thing. Something is coming, and it's big. By the summer of 2008, rumors were growing. Credit rating agencies threatened to downgrade Lehman. Short-term lenders started pulling back their funds. Lehman had reached a point where it could not survive if it failed to secure new debt daily. This situation was like walking on a tightrope. One wrong step, and that step was very close. By September 2008, everyone felt that things had reached a point of no return. Closed-door meetings in New York's financial center went on for days with no results. They were searching for a buyer for Lehman, but no one trusted the bank's balance sheets. On September 12th, a critical meeting took place at the New York Fed building. Barclays wanted to buy, but the UK government denied permission at the last moment. No alternative remained. And on the morning of September 15, 2008, at 1:45 a.m., a turning point in world financial history occurred. Lehman Brothers declared bankruptcy. $639 billion in assets, $613 billion in debt. This was not just the collapse of a large bank, it was proof of how fragile the supposedly unbreakable structures of modern capitalism really were. As soon as the bankruptcy news spread, markets froze. The Dow Jones fell 500 points in a single day, an unprecedented collapse until that time. Banks stopped lending to each other. Credit flow stopped. The global financial system held its breath simultaneously. The next day it became clear that insurance giant AIG was also on the brink of collapse. The government had to announce an emergency $85 billion rescue package. The same week Washington Mutual collapsed, Merrill Lynch was sold. Lehman's bankruptcy had not only ended itself, but also triggered the collapse of the global order. Because the financial system was tightly interconnected, when one link broke, the entire chain shook. This was an event that would be talked about for years and would change the course of the world economy. And no one that morning knew how deep the collapse would become. 1. Banks can no longer take risks as before. After Lehman's fall, the whole world realized one thing. No one really knows what banks are doing. Complex derivatives, hidden risks, bloated balance sheets. And government said, okay, you're free, but not this much anymore. The Dodd-Frank Act came in the U.S., regulations in Europe became twice as strict. Banks could no longer receive special treatment for being too big. In short, banking was no longer the Wild West. 2. The concept of stress test entered our lives. Before Lehman, no one cared what banks would do in a crisis. Suddenly, the question changed. Can a bank really survive a crisis? Today, major banks worldwide must pass this exam from the government every year. What if the economy collapses? What if interest rates suddenly rise? What if unemployment spikes? Can the bank survive? After Lehman, this became mandatory. 3. Investor confidence changed. Fundamentally, Lehman's collapse still leaves a scar in market memory today. Since that day, investors started thinking 3 times before every penny. Is this company really solid? How much debt does this bank have? What is it hiding on its balance sheet? Interestingly, but true, confidence became as valuable an asset as money itself. If a company loses trust, it can fail. Lehman proved this. 4. Central banks became superpowers. When Lehman collapsed, markets fell so sharply that the U.S. Federal Reserve suddenly became the world's most powerful player. They cut interest rates to 0, purchased trillions in bonds, directly rescued banks. Result? Central banks today are not just institutions for monetary policy. They act like emergency doctors for the global economy, and this role began after Lehman. 5. Too big to fail is now a threat. Lehman's collapse also showed this. If a bank is too big, its failure can collapse the whole system. Today, many countries discuss the idea of breaking up giant banks. Limits have been placed on how much, because after Lehman, no one wants to see the domino effect again. 6. Finance is everyone's business now. Before Lehman, the financial world was a distant universe for ordinary people. Some looked at charts, some caught the news. But when Lehman collapsed, unemployment surged, housing prices fell, retirement funds shrank, and everyone realized if finance collapses, life collapses. That's why today economic news, interest rate decisions, and bank balance sheets concern everyone. Closing sentence, video finale. The collapse of Lehman Brothers was not just the end of a bank. It was the greatest proof that no system without oversight can survive on its own. And perhaps most importantly, to understand today's financial world, we need to know what happened that day.